The stock market, often seen as a barometer of economic health and a platform for wealth creation, is also a theater of human emotion, speculation, and sometimes irrationality. This dynamic environment is subject to episodes of madness, where logic and fundamentals are overshadowed by exuberance, fear, or panic. Understanding this madness can provide valuable insights into market behavior, investor psychology, and the broader economic implications. The nature of stock market madness. Stock market madness refers to periods when market behavior deviates significantly from rational expectations. These episodes are characterized by extreme volatility, rapid price movements, and a disconnect between stock prices and underlying economic fundamentals. Such madness can be driven by a variety of factors, including speculative bubbles, financial crises, and mass psychological phenomena. Historical examples of market madness. Throughout history, the stock market has experienced numerous episodes of madness, each with its unique characteristics and consequences. Some of the most notable examples include 1. The Tulip Mania, 1636-1637. Often cited as the first recorded speculative bubble, the Tulip Mania in the Netherlands saw the prices of tulip bulbs skyrocket to extraordinary levels before crashing. At the height of the mania, a single tulip bulb could cost more than a house. This episode illustrates the power of speculative fervor and the eventual collapse when reality sets in. 2. The South Sea Bubble, 1720. The South Sea Company, a British trading company, saw its stock price soar due to exaggerated claims of its potential profits. Speculation drove prices to unsustainable levels, and when reality failed to meet expectations, the bubble burst, leading to significant financial losses for investors. 3. The Great Depression, 1929 to 1939. The stock market crash of 1929 marked the beginning of the Great Depression, a period of severe economic downturn. The crash was preceded by a speculative bubble driven by easy credit and excessive leverage. When the bubble burst, it led to widespread panic selling and a prolonged economic crisis. 4. The dot-com bubble, late 1990s, early 2000s. Fueled by optimism about the Internet's potential, the dot-com bubble saw technology stocks reach unsustainable valuations. Companies with little or no profit were valued at billions of dollars. When the bubble burst, many investors faced significant losses, and numerous tech companies went bankrupt. 5. The Global Financial Crisis, 2007-2008. The global financial crisis was triggered by the collapse of the housing market bubble in the United States. Excessive risk-taking, lax regulation, and complex financial instruments contributed to the crisis. The subsequent market crash led to a severe recession and prompted unprecedented government intervention. Psychological drivers of market madness. Market madness is often driven by psychological factors that influence investor behavior. Understanding these factors can shed light on why rational decision-making sometimes gives way to irrational exuberance or panic. 1. Herd behavior. Herd behavior occurs when investors follow the actions of others rather than relying on their independent analysis. This behavior can amplify market trends, leading to bubbles during uptrends and crashes during downtrends. The desire to conform and fear of missing out can drive herd behavior. 2. Overconfidence. Overconfidence leads investors to overestimate their knowledge and ability to predict market movements. This can result in excessive risk-taking and speculative trading, contributing to market volatility and bubbles. 3. Anchoring. Anchoring is the tendency to rely heavily on the first piece of information encountered when making decisions. In the stock market, this can lead to irrational price expectations based on historical highs or lows, rather than current fundamentals. 4. Confirmation bias. Confirmation bias causes investors to seek information that confirms their existing beliefs while ignoring contradictory evidence. This bias can perpetuate market trends and delay recognition of changing conditions. 5. Fear and greed. Fear and greed are powerful emotions that drive market behavior. Greed can lead to speculative bubbles, while fear can trigger panic selling and market crashes. These emotions often override rational analysis and lead to extreme market movements. The impact of market madness. The consequences of stock market madness can be far-reaching, affecting not only individual investors, but also the broader economy and financial system. 1. Wealth destruction. Market madness can lead to significant wealth destruction when bubbles burst or markets crash. Investors who bought at inflated prices may face substantial losses, eroding their financial security and confidence in the market. 2. Economic dislocation. Severe market downturns can lead to economic dislocation, as declining asset values impact consumer spending, business investment, and overall economic activity. This can result in recessions or prolonged periods of economic stagnation. 3. Regulatory response. Episodes of market madness often prompt regulatory responses aimed at preventing future crises. These responses can include increased oversight, stricter financial regulations, and measures to enhance market transparency and stability. 4. Investor behavioral change. Market madness can lead to changes in investor behavior as individuals become more cautious and risk-averse. This can impact market liquidity and trading volumes, influencing future market dynamics. Strategies for navigating market madness. While market madness presents challenges, it also offers opportunities for savvy investors who can navigate the volatility and uncertainty. Here are some strategies for managing the risks and capitalizing on opportunities. 1. Diversification. Diversification is a fundamental strategy for managing risk in volatile markets. By spreading investments across different asset classes, sectors, and geographies, investors can reduce the impact of market madness on their portfolios. 2. Risk management. Effective risk management involves setting clear investment goals, defining risk tolerance, and implementing strategies to protect against downside risks. This can include using stop-loss orders, hedging, and maintaining adequate cash reserves. 3. Contrarian investing. Contrarian investors seek opportunities by going against prevailing market trends. During periods of market madness, contrarian strategies can involve buying undervalued assets or selling overvalued ones based on a thorough analysis of fundamentals. 4. Long-term perspective. Maintaining a long-term perspective can help investors weather short-term market madness. By focusing on the underlying value of investments and staying committed to a well-defined strategy, investors can avoid making impulsive decisions driven by fear or greed. 5. Education and awareness. Continuous education and awareness of market trends, economic indicators, and psychological biases can empower investors to make informed decisions. Understanding the root causes of market madness can enhance decision-making and improve investment outcomes. Conclusion. The stock market's inherent volatility and complexity make it susceptible to episodes of madness, where irrational behavior and speculation overshadow rational analysis. While these periods present challenges, they also offer opportunities for those